Grab these growth stocks before rate cuts begin. These rate-sensitive stocks seem poised to rally when the Federal Reserve starts cutting interest rates later this year. Air Test Systems, a semiconductor testing outfit poised for a rebound when rates fall. Manilian, this fintech lender is ready to ride renewed lending activity driven by lower interest rates. Realty Income, a rock-solid real estate giant prepared for a massive interest rate-driven housing reversal. Let's dive in. Here are the 3 stocks to buy ASAP for a rate cut windfall in 2024. Welcome to Timely Investment Research. Have you noticed the headlines about potential interest rate cuts this year? I bet your portfolio has too. The potential for the Federal Reserve to begin cutting interest rates is a big deal. Indeed, such a move could mean big upside for some unloved stocks in 2024. Inflation is cooling, and the economy seems strong enough for the Fed to step back and take a breather. Rate cuts could come as early as this spring. That means now could be the perfect time to grab shares in a few companies that should pop when interest rates fall. Higher rates have bruised many stocks as borrowing got pricier and customers pulled back on spending. But those stocks could bounce back fast when interest rates decline. Thus, it is a good idea to snap up some of these beaten-down names before the Fed capitulates to the market and investors pile in. These companies have solid businesses that should thrive again as capital becomes cheaper and demand recovers. Let's dive in. Number 1. Air Test Systems. Air Test Systems nosedived 71% from its peak in September 2023. This has led many investors to ask, what gives? Blame the overall EV market slowdown for dragging this semiconductor firm down, or blame higher interest rates. Air provides critical testing equipment to EV-related chip makers. So when Tesla and other EV makers hit speed bumps from higher rates, it rocks Air's business as EV-related semiconductor demand decelerates. But I believe Air has promising upside when rates fall, especially considering EV adoption still stands at just 1% of vehicles on roads globally. Thus, the company's long-term growth story remains intact. Air has no worrisome debt levels and a strong balance sheet to boot. Despite the industry cooldown, analysts still forecast strong earnings per share growth of around 30% this year. Once the Federal Reserve cuts rates, renewed optimism should also recharge Air's sales growth. Revenue expansion is expected to accelerate from 19% to 34% year over year in the company's fiscal years from May 2024 to May 2025. To me, that screams buying opportunity. Indeed, buying Air Test Systems stock around 20 times forward earnings seems to be a bargain. This is a stock to buy before more investors catch on and bid the company's share price higher. Number 2. Manilian. Unlike Air, online lender Manilian has actually defied the market gloom and doom over the past year, with its stock up 90%. However, Manilian stock is still down 22% in 2024 after a slight third-quarter revenue miss. To me, that looks like a temporary hiccup. There's no reason to doubt this leading fintech disruptor over the long haul. Remember, softer rates typically translate into more risk-taking among financial institutions as lending volumes improve. Manilian's AI-powered lending platform should attract even more banking partners and customers when rates drop. Borrowing and lending activity has slowed lately amid interest rate-driven uncertainty. But clarity on the Fed's path hiking or cutting path could bring back loan demand in a big way. Manilian's management knows it too. The CEO recently noted that the current rate fog has made lenders extra cautious. Once this fog lifts and interest rates fall, lending activity should pick back up. Manilian is making big strides toward profitability, regardless. Analysts are projecting the company could reach that milestone in 2025. For a fintech growing revenue of around 20% annually through that period, I'm happy to buy Manilian stock before the herd catches on. Number 3. Realty Income. Real estate has felt understandably sketchy amid spiking interest rates. But I don't believe Realty Income warrants the persistent 33% discount off its pre-2020 highs in the $80 per share zone. In fact, real estate prices overall have climbed substantially higher since then, though they've dipped recently. Still, Realty Income managed to produce healthy 24% year-over-year revenue growth last quarter. This is a company perfectly positioned to capitalize when mortgage rates drop and unleash pent-up housing demand. Many prospective home buyers have delayed their home purchase plans, choosing instead to stash their cash until lower mortgage rates return. Notably, realty income can also benefit from these lower interest rates, as its $21 billion in debt will become much easier to service as rates come down. Best of all, investors can sit back, collecting 5.7% dividends while awaiting a rebound. With modest downside risk here, buying realty income stock at these levels makes sense despite the current uncertainty in the real estate market. This is a long-term income-producing cornerstone holding to buy ahead of the crowd. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.